Zillow and now Redfin have shut down their iBuying programs, and Opendoor is in serious trouble.
Look at how quickly this market has flipped on Opendoor.
Opendoor lost $400 million, guys.
Opendoor, a home flipping company, announcing layoffs of 18% of its employees. That amounts to roughly 550 people.
Opendoor is very likely to close their doors.
Opendoor. Is it a disruptive tech juggernaut or a hollow balloon ready to pop? If it is a prop tech juggernaut, how can it lose $1.35 billion? Yes, that's billion with a B. Zillow shut down its iBuyer business in 2021. Redfin followed suit, shutting down RedfinNow in 2022. And OfferPad is now a penny stock. Here's a bold prediction. Opendoor will be bankrupt in 24 months. In this video, I'll share with you my 5 reasons why I don't think Opendoor will be around in 2025. Number 1, Opendoor will never be profitable. 2, Opendoor make lowball offers and purchase far fewer homes in 2023 and 2024. 3, Opendoor's valuation algorithms are overrated, and I'll tell you why I think that. Number 4, Opendoor's management's vision is flawed. And number 5, Opendoor Exclusives, its new marketplace product, is not a compelling proposition.
This video is brought to you by Houzeo, America's most advanced home buying and selling platform. Americans across the nation are saving on commissions with Houzeo.com. You can too. Check out Houzeo.com on the web or the Houzeo mobile app.
If you're even remotely interested in the housing market, you've heard of Opendoor. It is an idea germinated in Silicon Valley, nurtured in the bosom of the tech elite, venture capitalists, and industry heavyweights. Opendoor was founded by Keith Rabois, a member of the PayPal mafia, and an investor in YouTube, Palantir, Lyft, and Airbnb. And its investors are the who's who of Silicon Valley. Sam Altman of Y Combinator and ChatGPT. Max Levchin, another member of the PayPal mafia and the co-founder of Affirm. Gideon Yu, who is the former YouTube and Facebook CFO. Kevin Hartz, the co-founder of Eventbrite. And the list goes on. Opendoor has raised $2 billion in 10 funding rounds, which shows just how confident investors were in Opendoor's potential. $6 million in a venture round on 16th of May 2014, $10 million in July 2014, $20 million in February 2015, $80 million in October 2015, $210 million in 2016, $135 million in January 2018, $325 million in June 2018, $400 million in September 2018, $300 million in 2019, and $400 million in December 2020 when it went public through a special purpose acquisition company, or SPAC. Wow. In 2020, the company's enterprise value was $4.8 billion. In 2021, Opendoor's stock peaked at $39 per share. Then, the housing market took a turn, and Opendoor's fate turned with it. In December 2022, their stock hit rock bottom at less than $1 per share. Some skeptics always believed that success would be Opendoor's fair weather friend, unlikely to stick around if the housing market slowed down. But supporters believed in Opendoor's algorithms and technology. Will it succeed? Will it fail? Let's look at the facts first. State of affairs at Opendoor. To understand what Opendoor is going through, we must look at its financials. But before that, let's consider what Opendoor does. Opendoor is a real estate technology platform that buys properties from home sellers and sells them for profit. Opendoor claims to use sophisticated algorithms and the latest machine learning technology to make instant price offers. That sounds fancy. AI, machine learning, algorithms, data science, and technology. But in reality, Opendoor is just a home flipper. Opendoor buys homes, in some cases fixes them up, and sells them for a profit. Opendoor also makes money from service charges and repair costs. For example, they charge 5% of the home's price for their services. If the property needs repairs, they will deduct those costs from the offer price as well. Now that we understand this, let's look at its finances. Opendoor published its fourth quarter 2022 financial report on February 23rd, 2023, and that is where we'll pull our numbers from. Homes bought and sold. Opendoor bought 34,962 homes and sold 39,183 homes in 2022. The total value of their assets was $6.6 billion. To maintain its business model, Opendoor needs to continue buying homes, and they have to make a profit on these flips. Flipping houses is nothing new. Amateurs and experts alike have been flipping houses for decades, and there's profit to be made. But Opendoor's business model is to use AI, machine learning, and sophisticated valuation models, and make money off of the 5% transaction fee it charges. It is a good business model when prices are going up, but even then, Opendoor never made a profit. This business model is especially problematic when you consider the current market conditions with dropping home prices and slowing demand for single-family homes. However, Opendoor can reduce the impact of this downturn by reducing the size of their inventory, which is what they did in 2022. Opendoor purchased 34,962 homes in 2022, which is down 5% from 2021. The total value of the company's inventory dropped by 27%. Money borrowed. Opendoor borrowed $10 billion in 2022. They managed to repay $11.9 billion during this time as well. However, they are still in considerable debt and have a lot of inventory sitting unsold. As of Q4, Opendoor owes $4.4 billion. Approximately $1.4 billion in current liability must be paid back in 12 months, and $3 billion is non-current debt. Naturally, this debt also attracts hefty interest. In 2021, Opendoor paid around $143 million in interest. But then the housing market soared, and home prices reached historical highs. Opendoor borrowed more money to buy these expensive homes and must now pay interest on these loans. In 2022, Opendoor paid $385 million in interest alone, which is nearly 2.7 times the amount they paid in 2021. Interest isn't the only expense on Opendoor's plate. There are several overhead costs that eat into Opendoor's earnings: expenses and overhead. Every business needs to deal with overhead costs, and Opendoor is no exception. In fact, Opendoor spends a lot of money to run its business. These costs include tech and algorithm maintenance, buying homes in cash, hiring local professionals to assess the properties, taxes, utilities, and other costs to hold homes until sale, repair and renovation costs, sales, marketing and administration costs, and financing costs. Opendoor spent around $544 million on sales and marketing in 2021. They spent nearly 2 times that amount on sales and marketing in 2022, shelling out a little over $1 billion. Their general and administrative overhead costs decreased during this period. They spent around $620 million in 2021 and around $346 million in 2022. Opendoor reduced its expenses significantly by firing 18% of the staff. Now that we know their expenses, we must look at the company's revenue and loss. At first glance, the company's sales revenue numbers seem impressive. Opendoor made $8 billion in revenue in 2021. That number shot up to $15.5 billion in 2022. That is a significant jump in revenue. So you would imagine that they would have some profits. No. Opendoor lost $662 million in 2021 and $1.35 billion in 2022. Now that we understand Opendoor's business model and its financials, let me tell you why I don't think Opendoor will be around in 24 months. Reason 1, Opendoor will never be profitable. Opendoor's financials paint a fascinating picture. It generates a profit on a typical home flip, but its operational expenses are so high that net, Opendoor loses eye-popping amounts of money. It is pretty clear that the company must sell more homes to cover all expenses and generate profit. But exactly how many homes does Opendoor have to sell to be profitable? The first thing to calculate is the contribution profit after interest. Contribution profit after interest is the earnings from all home sales minus the home purchase cost, repair cost, holding and selling cost, and interest. According to Opendoor reports, in 2022, their adjusted gross profit was $1.086 billion. We deduct holding cost in the current period, which is $109 million, and we deduct the holding cost of the prior period, which is $38 million, and the direct costs associated with selling these homes, which is $414 million. This all adds up to a contribution profit of $525 million. This is reflected in Opendoor's fourth quarter 2022 financial results. If you divide this number by the number of homes sold, which is 39,183, you get the unit margin, or the gross profit from every property Opendoor sells. The unit margin is $13,000. But you already know that Opendoor has borrowed a ton of money to purchase these homes, so we have to deduct that interest expense. Opendoor has two kinds of debt: senior debt and mezzanine debt. Senior debt is the money borrowed to purchase these homes. In the Q3 2022 report, Opendoor broke down its total debt and provided figures for both the senior debt and mezzanine debt. Opendoor's latest financial report from Q4 2022 does not break this down, but based on the numbers till Q3, we can extrapolate that the senior debt would be somewhere around $145 million and mezzanine debt around $240 million. Let's add that senior debt to our table. This brings the contribution profit after interest to $380 million, which means the unit margin is around $9,698. In other words, Opendoor made a profit of around $10,000 on average on every home they sold in 2022. To calculate Opendoor's break-even point, we now have to calculate their fixed costs. These are costs that don't vary linearly with the number of homes they buy and sell. For example, the CEO's pay, their headquarters rent and utilities, the cost to maintain their valuation algorithms, their marketing costs, and so on. Reading into their annual report, their fixed costs are sales, marketing, and operations, $859 million. General and administrative, $346 million. Technology and development, $169 million. And interest on the mezzanine debt facilities that we calculated before, $240 million. That's a total of $1.6 billion. So to break even, they have to sell 166,425 homes. To hit that number, they will have to be as big as one of the top 5 brokerages in the US. Now, before you say, hey Josh, that's doable, I have to remind you that all of these brokerages, EXP, Compass, Realogy, and Redfin, are asset-light businesses. They do not actually have to put any money towards buying the homes. Opendoor does. Modern MBA did a calculation of how many homes Opendoor would have to sell to break even in 2021's hot market. They came up with 58,263 homes. But even that would be humongous for Opendoor, and it would still put them firmly as the 6th biggest brokerage behind Redfin. I hope that gives you a sense of how far profitability is for Opendoor. In Q4 2022, Opendoor's contribution profit was negative, which means regardless of how many homes they'll flip, they'll never be profitable. Reason 2. Opendoor will make lowball offers in 2023 and 2024 and purchase far fewer homes. Opendoor's success has largely been due to unusual market conditions. We had artificially low interest rates, limited housing supply, and rising home prices. This was an ideal time for Opendoor to buy properties and flip them for profit. Times have changed. The housing supply is at 4.1 months and rising. Home prices have dropped by 6% overall and by more than 13% in markets like San Francisco, and they continue to drop. Homes are sitting on the market for more than 51 days on average, which spells disaster for Opendoor. Every day that property sits unsold is money down the drain. Fannie Mae just released their forecast stating that home prices will continue to decline through 2024. Let's look at a traditional housing market cycle. Home prices go up and then they go down. When home prices are going up, Opendoor buys a house at T1. The company holds onto the property and then sells it at T2. The difference in home value between these 2 points is their profit. In an upward trending market, Opendoor can afford to pay the fair market value of the homes they buy, and they will still make a profit because prices are rising. That's why you heard reports of Opendoor paying more than 100% of the fair market value in some cases. However, when home prices are declining, it's a different story. Say Opendoor buy a house at T1- and sells that house at T2-. If Opendoor paid market price or even close to it, it'll lose a lot of money because by the time Opendoor sells, the prices would have dropped. Because Opendoor needs to make a profit on every home, the price they offer in a declining market at T1- has to be significantly lower than the fair market value of the property. That's the only way they will make a profit when they sell at T2-. This means that Opendoor offers will be far below market value. The only way Opendoor was able to flip 39,000 homes in 2022 was by offering fair prices to home sellers. Now, you can expect their offers will be far below the market value of the homes they are looking to purchase, and Opendoor will be buying far fewer homes. Separately, Opendoor can't really buy a lot of homes in the current market because their interest expenses have shot up and rates have risen. Reason 3. Opendoor's algorithms are overrated. Opendoor claims that it has built a valuation algorithm that can compare hundreds of pairs of comps for any given address and provide a reliable price that feeds into Opendoor's offer. Then they can adjust the estimated price for the home's features, like granite countertops, yard size, and even road noise. For any iBuyer, their valuation algorithms have two jobs: provide a price estimate for the house when purchasing, and forecast the change in price upon sale. This would factor in the forecasted average days on the market. Opendoor's algorithms are sophisticated. That's one of the reasons why 10% of home sellers who request a cash offer from Opendoor end up accepting their offer. Valuation algorithms have two glaring weaknesses though. First, forecasting change in prices is hard. Second, these models have been trained with data primarily from in a low interest rate environment or in a decreasing interest rate environment. It is very hard to find clean data to forecast home prices and change in prices in a rapidly increasing interest rate environment. Opendoor's co-founder and ex-CEO Eric Wu admitted as much in November 2022, stating that his algorithms couldn't predict the sharp decline in home prices. Zillow, the most well-funded and profitable residential real estate company, and the one with the best-known home pricing algorithms, lost more than $500 million in their iBuying foray. Zillow Offers. Zillow's estimates median error rate for off-market homes is 7.49%. 7.49%! That's more than Opendoor's annual contribution margin target of 4% to 6%. And Opendoor is betting billions of dollars on these algorithms. Oh, talking about that 4% to 6%, contribution margin target. Reason 4, Opendoor's management's vision is flawed. Opendoor is a home flipper being valued as a technology company. A typical technology company would have net margins from anywhere between 30% to 50%. Zillow is a real estate technology company. Its gross profit margin before fixed expenses is around 80%. Opendoor's leadership has set a contribution margin target of 4% to 6%. 4 to 6%. Most home flippers I know wouldn't be bothered to invest in a flip where they aren't making north of 15% net profit. Opendoor's target is absurdly low. Opendoor will likely be flipping much fewer homes in 2023 and 2024. With these margins, you can expect continuous eye-popping losses. Reason 5, Opendoor Exclusives is not a compelling product. Yet. In November 2022, Opendoor's then CEO and co-founder Eric Wu stepped down to focus on Opendoor's new marketplace product, Opendoor Exclusives. The vision is to create a competitor to the MLS, and in that way, Opendoor Exclusives is similar to Compass Exclusives and the newly launched Houzeo Exclusives. CEO Carrie Wheeler explained the value proposition of Opendoor Exclusives in Opendoor's 4Q 2022 earnings call.
And what's the value proposition to sellers? The value prop to them is if they opt into putting in their home in the marketplace, they're still looking at a scenario where they are not enduring more than one showing. Then they have a limited window of time by which we are going to surface multiple offers for them. One from the institutional network that we have in our relationships, which we've had for years now. We can help monetize those and bring those offers to the fore that they can't otherwise get. And we can bring other offers from other buyers in our network to them. And then they have the option to choose to take that price or not. They obviously also have the backup of our certain all-cash offer if that's something they want to avail themselves. So it's a lot less burdensome, less time. There's still certainty in the process. Again, vastly superior to the traditional selling process today. That's the value prop to them.
This value proposition to the home seller is not compelling. The MLS offers far more exposure, and there are no commission savings. Opendoor charges home sellers a 5% commission on Opendoor exclusives. It is currently live only in Texas, but if Opendoor is hanging its hat on Opendoor exclusives, it'll have to significantly enhance the value proposition for home sellers. So, will Opendoor survive? Opendoor was propped up by hotshot Silicon Valley VCs and their fairy tale valuations. It went public through a SPAC and avoided the scrutiny that comes with the IPO process. But now that it is public, its billions of dollars in losses have been laid bare. Opendoor stock price has plummeted and is dangerously close to the $1 mark, where it would be booted off the New York Stock Exchange. Opendoor's primary competitor, OfferPad, has already received that notice from the NYSE.
Inman reported on November 21st that OfferPad may be delisted from the New York Stock Exchange.
If you want us to do a similar analysis on OfferPad, then let us know in the comments below. Don Mullen, the CEO of one of Wall Street's biggest home buyers, Pretium, said it first. iBuyers will be out of business in the next 24 months. I agree with him. Opendoor will be history in 24 months, unless it refines its business model. What do you think? Do you think Opendoor will survive, or will it crash like other iBuyers as the market slows down? Let us know in the comments below. If you like this video, you should also watch our video on the rise and fall of Rex Real Estate. It's a fascinating story on how Rex claims Zillow and the NAR crushed its business. Be sure to check it out and let us know what you think. That's it from us. We'll see you soon in another video. Don't forget to like, share, and subscribe.